SBR current issues, right? And current issues are really very important for every student of SBR because it is a mandatory question, and you won't get much material on this areas of the exam, and that's why I thought to help you guys. Anyways, climate related disclosures and investor focus is one of the current issue, can be one of the current issue question in your SBR exams. So, climate change. Climate change is impacting both society and companies alike. Corporations are responding to its impact, and one of the reasons is that investors are demanding actions on it, right? So, what investors actually want, they want to know. Investors need to know how a company. Investors need to know how company is considering the impact considering the impact of climate change on its business model. On its business model, risk strategy, and effect, effect on financial statements, right? So investors want to understand the future challenges that the company faces and what the company plans are to deal with these challenges. So, the Paris Agreement, United Nations, is a legally binding international treaty on climate change, which will require significant reallocation of company resources if the agreed goals are to be met. Therefore, companies could be exposed to a wide range of risks and opportunities as they aim to meet these goals. Companies will need to disclose financial implications of climate related challenges that faces them, right? Companies will need to disclose the financial implication of climate related challenges that face them. Okay. So, nowadays a number of number of companies are providing narrative reporting on climate related issues where minimum legal requirements are being met. Investors are calling for additional disclosures to inform their decision making, right? So, some of the information that investors requires are as follows. That investors require are as follows. Number one, the arrangement in place and strategy for assessing and considering climate related issues. assessing and considering climate related issues. Number two, the metrics used to monitor climate related goals and targets. Climate related goals and targets. Number three, the viability of the company's business and business model. Of the company business and business model. Four, uh, the assessment of the company's viability. Over the longer term, taking into account climate related issues. Five, are the risks and opportunities reflected in the financial statement. In the financial statement, for example, the effect of assumptions. Effect of assumptions used in impairment testing. Depreciation rates. And decommissioning, etc. Right. So far, so good. Now let us look at one of the major part of this session, and that is climate change and international financial reporting standards. So, firstly, let us look at for IAS 1 presentation of financial statements. IS1 requires disclosures of information not specifically required by IFRS standards and not presented elsewhere in the financial statement, but it is relevant to understanding of the financial statement. Additionally, IS1 requires a company IS1 require company to consider whether any material information is missing, is missing from its financial statement, such as impact on the climate related matters, on the company's financial position and performance, on the company financial position and performance. Number two, disclosures of assumptions about climate related matters may be required where assumptions have been affected by climate change, affected by climate change. For example, estimates of future cash flows for impairment testing for the purpose of the calculation of decommissioning obligations. The disclosures may include the nature of the assumptions or the sensitivity of the calculation. All right. Further, it may IS1 requires management to assess a ability to continue as going concern climate related matters may create material uncertainties that cause significant doubt upon a company's ability to continue as going concern. IS1 requires disclosures of those uncertainties. Also, IS1 requires uh, disclosures of the judgments that have a significant effect on the amounts recognized in the financial statement. Right. So that's related to IAS 1. Now let us look at IAS 2, inventory. So as far as IAS 2 inventory concerned, climate related matters may cause a company's inventories to become obsolete, or the value to decline, or cost to completion to increase, right? Climate related matters may cause a company's inventories to become obsolete, or the value to decline, or cost of completion to increase. IS, as you all know, IS2 requires inventories to be valued at lower of cost and net realizable value, right? And net realizable value is the estimated selling price in the ordinary course of business less the estimated cost of completion and the estimated cost necessary to make the sale. Estimates of NRV will be based on most reliable evidence available of the amount which the inventories are expected to realize. Now, number three, what we have to look at, we have to look at IS 12, income taxes. Okay, income taxes, IS 12 requires, as you know, IS 12 requires companies to recognize deferred tax assets or deductible temporary differences and use tax losses and credits to the extent it is probable that the future profit, taxable profit, will be available against which those amounts can be utilized. Right. So climate related matters may affect. Right. So IS 12 requires what it requires. Let me write it for you: to recognize deferred tax assets for deductible temporary differences and unused tax losses and credits to the extent it is probable that future taxable profits will be available against which those amounts can be utilized. So, climate related matters may affect companies' estimate of future taxable profits, which may result in potential deferred tax assets not being recognized or the de-recognition of already de-recognized deferred tax assets, right? So Climate related matters may cause company 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 future taxable profits, which may result in potential deferred tax asset not being recognized, or the de-recognition of already recognized deferred tax assets. Right. Then we have IS 16 property plan and equipment. IS 16 property plant and equipment requires company to review the residual value and useful life of an asset at least each financial year, and if expectations differ from previous estimates, any change should be accounted for prospectively as a change in estimates. This is the thing I expect you all know already, right? So what can climate change brings to it? Climate related matters may affect the estimated residual value, residual value and expected useful life of assets because of obsolescence and or legal restrictions on their usage, or you can say on their use, right? So that was the issue related to IAS 16 property plant and equipment. Next one, IAS 36 impairment of assets. Climate related matters may give rise to an indication that assets are impaired. For example, right? For example, a decline in demand for products that are not environmental friendly that are not environmentally friendly, okay, could indicate impairment of that product or the manufacturing unit making the product, right? Right, and okay, an adverse change in the business environment of a company is an indicator of impairment as well. Then, number two thing, which you need to know in this case, in assessing value in use, company is required to calculate cash flow projections, based upon a reasonable and supportable assumptions, right? And that are best estimate of the future conditions, whereas companies need to consider whether climate change or climate change matters affect those assumptions, and also companies are required to disclosure the events, circumstances, and assumptions, circumstances and assumptions that led to the recognition of impairment. Impairment loss, which could include what it could include, which could include climate related matters. CRM means, or CRE, climate related events, actually, right? So far so good. Now we are moving to the next standard, and what it will be, it will be IS 37 provisions, contingent liabilities, and contingent assets. Okay, climate related matters may affect the recognition, measurement and disclosure, of liabilities, related to such things as penalties imposed by governments, for not meeting climate related targets. Or cause damage. Companies should disclose major assumptions about any future events that have affected a provision or contingent liability. Right. And then we have next standard. And what's that? We have IFRS 9, financial instruments. Okay. Climate related matters may affect a lender's exposures to draft, exposure to credit, losses caused by environmental disasters, or regulatory change. And also borrower's ability to meet debt's obligation to the lender. Climate related matters may affect the calculation of expected credit losses. If there is an impact on the different potential future economic scenarios, or the assessment of a significant increase in credit risk. The classification and measurement of loans, the classification and measurement of loans may be affected as lenders may include terms linking contractual cash flows to an entity achievement of climate related targets. Related targets, the lender would need to assess whether the contractual terms of the financial asset give rise to cash flows that are solely payments of principal and interest on the principal amount outstanding. Additionally, climate related targets climate related targets may create an embedded derivative that need to be separated from host contract from the host contract. Climate change may reduce the probability of a hedged forecast transaction occurring or affect its timing. Affect its timing. So in this case, the hedge accounting relationship may need to be terminated or they may be hedged ineffectiveness. Similarly, a reduction in the volume of highly probable forecast transaction may lead to partial termination under IFRS 9. Right? Then we have next standard, we have uh, uh, IFRS 13 fair value. IFRS 13 fair value measurement, FVM. So when making the critical assessment and judgments for measuring fair value, the entity should condition which conditions and the corresponding assumptions were known or knowable to the market participants. So the impact of climate change or fair value measurement would depend on the evaluation of whether the climate change would have been impacted market participants' valuation assumptions at the reporting date. So the information such as climate-related legislation available to the market at the reporting date may be relevant in making this evaluation. Okay, so yeah, climate-related legislation available to the market at the reporting date may be relevant in making this evaluation. This would include any corroborative or contrary evidence such as the timing and trajectory of observable market price. This may include any corroborative or contrary evidence such as timing and trajectory of observable market price, movements of related assets and relevant markets, movement of related assets in relevant markets, as well as information from other sources of market data up to the reporting date. Right. So the examples from my the above examples which I discussed here, are some of the examples from IFRS standards and not are not exclusive but are indicative of the far-reaching impact climate change will have on business reporting, right? And this area of business reporting, or you can say corporate reporting, is evolving as the investor and wider stakeholder demand for both financial and non-financial disclosures increases generally, right? So I hope this will help you folks in your examinations if you get this topic in your exam. See you soon. On the other hand, take care. Baba Sarai. Tada.